Did you commit to another CPA review course that just isn't aligned with how you learn? Well, spilled milk, baby. In the world of accounting, only one figure matters, and that's the bottom line. So by investing in Universal CPA Review, you're investing in yourself, and we promise to do everything in our power to get you the ROI that you're looking for by obtaining your CPA license. We know that purchasing a CPA review course is an investment, and we also know that spending all that money on a program that hasn't worked out sucks, and we want to soften that blow. Our Spilled Milk program will allow you to commit to Universal's Visual Learning CPA Review program at a steep discount. So reach out to info@universalcpareview.com to learn more about our program and what discounts you qualify for. Okay, so as we mentioned, technically we have two types of assets, but we have four scenarios when it comes to testing for impairment. Okay, so we already talked about testing for impairment related to property, plant, and equipment, as well as testing for impairment related to intangible assets, both those with a finite life and those with an indefinite life. So now we're going to talk about a very specific scenario related to testing for impairment for goodwill. Okay, so this test for impairment can feel overwhelming because we're using some slightly different terminology. But when you dive into it, you're going to see that this is not that overwhelming at all, and that testing for impairment for goodwill is actually very similar to testing for impairment for other intangible assets and for fixed assets. Okay, so let's start off by understanding what goodwill really is. And this is all going to come full circle when we dive into business combinations and the eliminating journal entries when applying the acquisition method. Okay, so that will be covered in later modules. All right, so now let's meet a company called Shark Corp, and we're going to assume that they are acquiring a subsidiary called Minnow Corp. And what we're ultimately going to learn is that when one company acquires over 50% of another company, they will have this controlling interest. Okay, so they're going to be required to consolidate the financial statements at the end of that year. Okay, so when we dive into the acquisition method stuff, we're going to talk about our 6-step journal entry. But in essence, what this acquisition method journal entry will indicate at its highest of levels is the purchase price of the subsidiary, which will be presented on the credit side of this entry, and the net identifiable assets, which are ultimately being acquired and will ultimately be presented on the debit side of this entry. And that ultimately makes sense, right? Because when something's coming in, it's going to be presented on the debit side. Whatever's going out the door, in this case, the cash for this investment is going to be presented on the credit side. Okay, so when this investment being made on the credit side is greater than what is being received on the debit side, that would mean that this journal entry would have an imbalance, and that imbalance is going to be plugged to goodwill. Okay, so taking a step back, we're essentially saying that Shark Corp paid more for this company, Minnow, than the total net identifiable assets fair value. Okay, so why would they do that if the dollar value doesn't reflect the purchase price? Wouldn't they be overpaying? Well, yes, and that effectively means that they are purchasing this at a premium. So why would they do that? Well, maybe buying this business isn't so black and white. Maybe there are some qualitative factors going on here. Okay, so some additional items might have value. Yes, on the exam, you can memorize that goodwill is all intangible assets that are not identifiable, right? But we want to be a well-rounded professional when we have our license. So let's think about this intuitively, right? What can this mean? Well, what if Minnow Corp has a great reputation or great customer support? That has value. Maybe that's the reason that Shark Corp is going to go ahead and feel comfortable paying this premium. Okay, and the reality is that this premium, right, this goodwill that isn't identifiable is ultimately going to be what is getting recorded and what we need to test for impairment. Okay, so if Minnow Corp has a decrease in its brand equity, or if Jamie, who effectively is the company's customer support team, quits randomly, then we have this decrease in value to that goodwill, right? So that is ultimately what we are testing for. Okay, so now diving into step 2. This is where the calculation is similar to how we previously calculated that impairment loss. Okay, so when we first discussed impairment losses for property, plant, equipment, right, our fixed assets, as well as those other intangible assets, we took a quantitative approach. Okay, so we're getting quantitative again now. And again, can't stress this enough. When we're talking about goodwill, specifically impairment loss related calculations for goodwill, we're focused on the reporting unit, right? Again, and I revert your attention back to other intangibles and other fixed assets. again and again because I can't stress enough that this is very similar stuff that we're doing now. Okay, only now we're focused on this reporting unit, not the intangible asset itself or a specific fixed asset that is getting tested for impairment. So, you know what? Here's what we're going to do. I want you to see this term reporting unit, and I want you to consider it the same essentially as the intangible asset or the fixed asset that we were testing for previously. So this calculation in step 2, after we have now determined that conditions have arisen that tell us that impairment losses exist, so now we're going to calculate how much impairment losses it is that we're talking about. So this is calculated as the difference between the carrying value of the reporting unit and the fair value of the reporting unit. Okay, so boom, that's the difference. This is our impairment loss related to goodwill. But one last thing, there's this sneaky caveat here. Come on, you didn't think that they were going to make it that easy, did you? The final thing to note when it comes to impairment losses is that this will be limited to the amount of goodwill that is currently being reflected on the balance sheet. So in other words, we have this impairment loss that we've calculated, great. But now we compare this to the goodwill amount that is currently sitting on the balance sheet, and it's the lesser of the two. Okay, so that is the meat of this calculation on the income statement. Quickly running through one quick thing to note related to what's getting presented on the balance sheet side. We're basically bringing down the value of goodwill. All right, but there is a chance that they might ask you something about the reversal of that value. Last thing to note is that there is no reversal to goodwill. In the same way that when intangible assets and fixed assets that are held for use have no restoration, right? If that fair value goes back up, we're not going to have a reversal to previously marked down goodwill. Okay, so let's run through a quick example and see how we put this to the test. All right, so no pun intended. Shark Corp is wrapping up its annual impairment analysis of the goodwill in its operating segment, MinnoCorp. MinnoCorp provided the following information related to its reporting unit. They had tangible assets. They had intangible assets other than goodwill. Right? This could be things like their patents, their copyrights, their trademarks, all that jazz. And then they have goodwill. Collectively, all three of these make up their reporting unit. Okay, so we know that we have an impairment loss. All right, the information tells us as much. Now in step 2, our quantitative approach, when determining how much this impairment loss will be recorded as, we're going to be comparing the total reporting unit's carrying value to its fair value. So as we said, the total of all three of these will make up the reporting unit's total. Okay, so we can write off this historical cost, not going to be relevant for determining the impairment loss. So the sum of the net carrying value of MinnoCorp's tangible assets, intangible assets other than goodwill, and their goodwill is $175,000. Okay, but the reporting unit's fair value is $143,400. So when comparing these two, we have an impairment loss of $31,600. The fair value is less than the carrying value. Okay, so this is going to be the reported impairment loss unless the goodwill reflected in the company's balance sheet is less than this amount, which is not the case. Right? It's ultimately going to be the lesser of the two. So the total impairment loss is going to be $31,600 to goodwill.